Did you know that as interest rates rise, it will affect your debt? Whether that's credit card debt, you might have an adjustable rate mortgage, or a HELOC on your home. As interest rates rise, so will your debt. Today, we're going to take a practical look at what the Federal Reserve is doing, how it's going to affect your wallet, and what you could do at the end to save some money. My name's Tommy Jordan. I'm a licensed real estate agent and mortgage broker here in California. Before we look at this article, we need to talk about the federal funds rate, or the Federal Reserve funds rate. Now, a lot of people hear, oh, the Federal Reserve is raising interest rate. Well, what are they exactly raising? Let's look at that, and that's going to give you a lot more context on this article and what's happening right now. Federal Reserve funds rate, what it means, the interest rate at which banks and other depository institutions like Wells Fargo, Chase, and all that lend money to each other, usually on an overnight basis, okay? So this is where it gets interesting, how it's used. Like the federal discount rate, the federal funds rate is used to control the supply of available funds and hence inflation and other interest rates. Practically, raising the rate makes it more expensive to borrow, okay? So that lowers the supply of available money, which increases the short-term interest rates and help keep inflation in check. Lowering the rate has the opposite effect, bringing short-term interest rates down. Currently, the Federal Reserve is raising this funds rate to stop us from going into a recession, because as they raise that funds rate, the short-term interest rates raise as well to help combat inflation. Now, say if the economy was in a depression or recession, they could do the opposite. They could actually lower that funds rate, which makes borrowing money a lot easier, a lot cheaper. It has like the inverse effect. So that's what we saw, just a few years ago with the pandemic. The Federal Reserve lowers that funds rate, borrowing becomes a lot cheaper, and boom, bada bing. The Federal Reserve is actually looking to raise interest rates today, this afternoon, 2 p.m. Eastern time. They're going to raise interest rates, but regardless if you're watching this a year later, the principles still apply to you in the future. Hi, Back to the Future. So after raising its key short-term interest rates from near zero by a 1/4 percentage point in March, the Fed on Wednesday, today, is set to push it up another 1/2 point, its largest bump in 22 years. That's pretty mind-blowing, okay? This move will drive rates higher on everything from credit cards to mortgages. It means your debt is going to get a lot more expensive in a hurry, says this analyst here, and we'll see why that's true. There's actually a few more interest rate hikes predicted for 2022. Goldman Sachs predicts the central bank will approve another 1/2 point increase in June before downshifting to 1/4 point increases the rest of the year. Okay, that would amount to a total of 2.25 percentage points in rate increases this year, the most since 1994, leaving the benchmark rate at a range of 2.25% to 2.5% by the end of 2022. That's crazy. So on the bright side, consumers, especially seniors, others on fixed income, will finally see bank depository rates rise from paltry levels, especially for online savings accounts and CDs. There is actually a silver lining from the Federal Reserve raising funds rates, because if you have a savings accounts or CDs, you'll start to get a little more return on your money. So this all goes back to the inflation, right? So the inflation rate in 2022, the consumer price index reached a 40-year high of 8.6% in March. Now, a lot of people actually think this number is double. So we're seeing the CPI being 8.6%. People think this is actually more like 15 to 20%. They might be lying to us a little bit. The Fed had held its federal funds rate near zero for 2 years to make borrowing cheaper and encourage spending to help lift the economy out of the COVID recession. And we spoke about that. So basically, it's a tricky balancing act, right? The Federal Reserve wants to raise the funds rate at a rate to help combat inflation, but if they do it too suddenly, we could also just go right into a recession. So it is a hard line to balance. Let's look at the federal funds rate in the last 50 years, and you can see how it's fluctuated up and down. So you can see in the 80s, it went up, then it goes down. In the 90s, up, down. 2000s, up, down. 2006, 2008, up, down. A few years ago, you could see with the pandemic, up, down, and right now around that zero level and starting to go up. But the interesting thing is to see how it correlates with US recession. So right here you could see dates of US recessions as inferred by GDP-based recession indicators. So you could see in the 70s right here, we had a recession. What happened with the federal funds rate? It was raised. You could see right here in the 70s, in the 80s, in the 90s, early 2000s, 2008, and then a few years ago, 2020. And if we go back to this other chart right here, look at that. So whenever there's been a recession, the federal funds has raised that rate, then they lower it after we, when the coast is clear, basically. These rising interest rates have a real effect on you and your credit cards. We're gonna take a look. Credit cards, adjustable rate mortgages, and home equity lines of credit will become pricier with the 1 or 2 months. That's because they're tied to the prime rate, which is in turn linked to Fed's benchmark rate. In other words, a Fed half-point increase is largely passed along. So credit card rates are averaging 16%, right? That's the interest rate. For a $5,000 credit card balance, a half-point increase probably will add $193 in total interest for borrowers who make the minimum monthly payment. With the federal funds raising that rate, there's going to be another $193 in total interest that you're going to have to pay just because that rate went up, because borrowing becomes more expensive. A total of 2 percentage points in rate increases the rest of the year would add $800 to interest until the balance is paid off. If you have a lot of credit card debt, it's important for you to try to pay that down, because as this federal funds rate goes up, your debt's going to become a lot more expensive and it's just going to go through the roof. And I think you need to smash this like button so that goes through the roof as well, so more people get to see this video and it helps grow the channel. Thanks. And also subscribe if you want to know about the housing market weekly. So let's take a look more about the credit card situation. This is the secret right here. Consumers with good credit can qualify for a balance transfer card that charges 0 interest for a year or more. Consolidating debts into a personal loan with lower fixed monthly rate is also a good option. For example, you have this credit card over here with $10,000 of debt with a super high interest rate. Every month you're just paying more and more on interest. If you could do a balance transfer where we take that $10,000 over here, we put it on a new credit card with 0% interest for the first year, because usually they have like introductory rates, and then after that you start paying interest. So if we could do that, then you could try to pay that off as quick as possible under that year time frame, so you're not just going more and more in debt on this other credit card. Another option is a personal loan with a fixed interest rate, and that's important because we don't want it adjusting with the market. So you have $10,000 in debt, you get a $10,000 loan, you pay off that debt on that credit card, then you're stuck with a 5% interest rate instead of a 16 to 20%. Another thing are adjustable rate mortgages, right? Adjustable rate mortgages are modified once a year after the fixed rate period ends. Typically after 5 years, right? The effects thus will be delayed, but then it could sting. An ARM whose rates rise from 3.85 to 5.85 the rest of this year would increase the monthly payment on a $300,000 mortgage, adjustable rate mortgage, by $363. The monthly payment could rise by $363 per month. So you might want to talk to your lender. Also, does it make sense to refinance, get into a fixed rate mortgage? They'll have to look at your finances, see if that even makes sense, but it's something to think about. How will this affect mortgage interest rates, right? Well, if you're on a fixed 30-year mortgage, you don't have to worry, right? It's not an ARM where it's fluctuating with the market. But if you're looking to get a mortgage, most likely interest rates for mortgages are going to continue going up in this next year or so. Here we go. The average 30-year fixed is at 5.1%, according to Freddie Mac, up from 3.1% late last year. That has raised the typical monthly principal and interest payment on a $300,000 mortgage by $346 to $1,628 a month. That is crazy. As the Fed follows through and boosts rates, mortgage rates could rise further, perhaps to 6%. that would lift the monthly mortgage bill by another $170 per month to almost $1,800. So you could see it doesn't always make sense to wait to buy. If you're in a position financially, downsizing, whatever's going on in your life, it might make sense to really buy something now, even with the higher interest rates, because they could just keep going up. And to remind you, you could always refinance later down the road to get out of that high interest rates, like say if they go back down to 3%. How is this going to affect auto loans? It's saying, well, not really. A monthly payment for a $25,000 car, 5-year loan would rise by about $6 a month. So, you know, that's like 2 Starbucks. Maybe that's 1 Starbucks. If you get like oat milk and you do like an ad shot, forget it. It's like a $10 drink. As Fed rates rise, banks will be able to charge a little more for loans, giving them more profit margin to pay higher rate on customer deposits. The average savings rate is a minuscule 0.06%. So that's nothing. The average 1-year CD inched up after the Fed's move, but it's barely noticeable from 0.14 to 0.17%. These probably won't budge much after the Fed acts Wednesday, but the average online savings rate has risen 0.5 to 0.54, and the typical online 1-year CD has jumped from 0.67 to 1%. Online banks have lower costs than the traditional brick and mortar kind of banks, so they can offer slightly better return on savings and CDs. The key takeaways is we got to eliminate any credit card debt you have, because that's just going to increase by either a balance transfer or doing like a personal loan option, right? If you have adjustable rate mortgage, keep an eye on that. Talk to a mortgage professional, and your savings and CD accounts, you know, you're probably going to get a little better return. So thank you so much for watching. Make sure to like, it helps. Subscribe for weekly videos, and I'll see you tomorrow. Yeah.